In this video, I'm going to cover several topics associated with the tax system. I'm going to talk about progressive tax, which is the way that the United States has their tax laws. Talk about negative taxes, state and federal taxes, capital gain taxes, and personal taxes. Actually, negative taxes I'm going to address in a little bit different order, but it's all in this video. So taxes, first of all, to understand what are taxes. Taxes are calculated as taxable income times the tax rate. So for a corporation, taxable income is all revenues minus all expenses. And in this case, those expenses are ongoing expenses and depreciation expense, which we've covered in several other videos. For personal, though, taxable income is the wages minus your deductions. I'm going to talk a little bit about one kind of deduction later on in this video, but there's generally two kinds: the standard per person deduction, or you can what's called itemize your deductions. And you do that if you have some other deductions beyond the standard, and that happens if you make large charitable contributions or you have interest expense on your home. So I'm going to talk later on in the video about how to calculate that interest expense. But the main part I want you to know is that taxes are calculated based on taxable income times the tax rate. So now we're going to turn, before I look at taxable income, especially associated with your personal taxes, we're going to look at tax rate. So in the United States, our system is based on taxable income, and your marginal tax rate changes the more income you get. So what this means by marginal is the tax on the next dollar you make. So if you make very little, the tax on the lowest amount is very small. But as you make more, that incremental jump in income is taxed at a higher rate. Not all of your income is taxed, but the incremental, that's what it means by the marginal tax rate. Now, you've probably heard that contrasted to a flat tax. So if you look at this, the income over time in a flat tax, we just have one straight flat tax as compared to a marginal tax. And you can see that the flat tax would be about, a little bit higher for some people and a little bit lower for other people. If your income is here, your tax rate would drop. If your income's here, it would go up, which is actually the reason why we don't have a flat tax rate, because going from progressive to flat means that those in the lowest income bracket will be hurt most, and those in the highest income brackets will be saving money. So the concept, that's why we haven't really switched to a flat tax rate. We are in a progressive tax system. So it's true for both corporations and for individuals. But this is the income tax rate for a corporation. So if you make between $0 and $50,000, you're taxed at 15%. If you make above $50,000, the incremental tax is based at 25%. So it's gone up. So the $7,500 is 15% of $50,000. And then if you go to the next bracket up to $100,000, between 75 and 100, you're taxed at 34%. And then 39%. And then it goes back down to 34%. And then it's at 35%, and then it's at 38%. And it's really odd, but this whole bracket, all of these jumps here, just have to do with negotiations around what the tax system should be for corporations. Most of the time, we use a 35% tax rate because that encompasses most everybody on the federal side, at 35%. So for state taxes, the California corporate tax is 8.84%. And so we need to incorporate that into the federal rate. So, and the way that we do that is we take the tax rate is going to be equal to the state rate times 1 minus the state rate times the federal rate. And the reason we do that is because state taxes are deductible on the federal return. So in this case, we do that, and it's about 41%, but we estimated at about 40% because tax rates change all the time. In addition to California taxes on the high side, so not all corporations are based in California, so we end up using a tax rate of 40%. Now for capital gains is when you sell an asset you've had for a long time and you have to pay taxes on the gain. Now this rate is, right now it's equal to the regular tax rate. And I have another video on how to calculate income on gain and sale of assets. But for now, just know that sometimes capital gains tax rates are different than income rates, but right now they're the same. As for negative taxes, the IRS never gives you money. So all of the time when you get a tax return, it's actually money that you overpaid to the IRS. But if you have a loss in a project and that project is part of a larger enterprise, the losses can offset gains in other parts of the company, so you can include a negative number in there. In addition, if that's not the case, you can loss carry forward or loss carry back. So if you have a loss in one year, you can bring it into the next year to shelter income for the next year. So what we just do in our calculations is we just leave taxes as negative, even though it doesn't make any sense. The IRS is not going to actually give you money back, but we go ahead and leave it that way for simplicity of calculations. Now in personal taxes, just so you know, the personal taxes are again equal to wages minus deductions, and usually this deduction is a standard deduction unless you own your own home, and then you will be able to get the interest portion of your payment as a deduction. Now I'm going to go through a calculation on how to figure out the portion of your payment that's interest, so we can kind of understand how to do this. Now I'm going to simplify this where we make yearly payments. Now of course we don't usually make a yearly payment, we usually make monthly payments, but the calculations are going to be very similar. So we have a loan that's $100,000 and it's a 10-year loan at 6%. So if I do the calculations for the payment, that's $13,590 a year. And I'm going to set up this table as a way of showing you how I get to the interest portion. In the first year and in every year, the payments are $13,590. The interest portion of this $6,000 is equal to $100,000 times 6%. That's the portion of interest. So that means of the $13,590, we paid $6,000 of interest, and the difference then, $13,590 minus $6,000, is the principal. And then that means that we paid off this much of the principal of the original loan. That's what it means by principal. So I take $100,000 minus $75,90 to get to $92,410, and that's the remaining balance. The next year, then, I have the payments the same. The interest is lower, though, because I'm doing the interest payment on this amount, $92,410. So I take $92,410 times 6% is $55,45. Then that means I made interest payments of $55,45. So the principal then is the difference between $13,590 and $55,45. So that's $8,045. Then that means the remaining balance is going to be $92,410 minus $8,045 to get to this remaining balance. The next year, the payment's the same. The interest is now on this amount, $84,365 times 6%. The principal is the difference between the payment and the interest portion. That's the amount we paid off on the loan. And then this amount is the previous loan balance minus the principal, give you that. And if you can see, I'm going to pay that every year, and you can see the interest is going down because the balance on the loan is going down, until finally the amount we remain is equal to the little bit of interest we paid less this principal, so we go to a remaining balance of 0. So what that means is that for your taxes in each of these years, this is going to be the interest portion that is deductible from your taxable income. So what we talked about in this video is a little bit about the tax system, the progressive nature of it. We looked at how to calculate taxes too, how to handle negative taxes, state and federal taxes combined, capital gain taxes, and personal taxes.